minutes because what I'm about to share could change the entire trajectory of your retirement. Imagine working your entire life, 30, 35, maybe even 40 years, paying into the system every single paycheck, believing that when you finally retire, your Social Security benefits will be waiting for you, completely free and clear. You've budgeted for your golden years based on the exact numbers the Social Security Administration promised you. You've done everything right. You've saved. You've sacrificed. You've played by the rules. But what if I told you that the IRS has laid a hidden trap? What if, simply because you saved diligently and built a modest retirement income, the government could target up to 85% of your Social Security checks for taxation? Not 85% taken away, let me be very clear about that, but 85% of your benefits becoming taxable income, added right on top of everything else you owe. And here's the kicker. The income thresholds that trigger this tax haven't been updated since 1993. They were never indexed to inflation. So every single year, more and more retirees fall into this trap, people who by any reasonable standard are solidly middle class. Today, we are going to fully expose the Social Security tax trap. We're going to break down the exact mathematical formula the IRS uses to penalize successful savers. And I'm going to give you a step-by-step blueprint to legally minimize this trap so you can keep more of the money you spent a lifetime earning. Protect your wealth through education. We bridge the gap between complex financial jargon and practical real-world asset protection. If you're serious about keeping what you've worked so hard to build, do me a favor right now, hit the like button, subscribe to the channel, and ring that bell notification. Every time you engage with the video, it helps us reach more people who need this information. I also highly encourage you to watch this video all the way to the very end. The final strategy I'm going to share, a specific timing technique involving your retirement accounts and your claiming age, could literally save you tens of thousands of dollars in unnecessary taxes over your lifetime. You do not want to miss it. Before we go any further, the important disclaimer, everything in this video is strictly for educational and informational purposes. It does not constitute personalized legal, tax, or financial advice. Tax laws are complex, they change, and everyone's situation is different. Always consult a qualified tax professional or financial advisor for your specific circumstances. All right, let's get into it. When most people transition from their working years into retirement, they assume two things. Number one, they assume their tax burden will magically drop just because they stopped earning a paycheck. And number two, they assume that their Social Security benefits, money they already paid taxes on during their working years through FICA payroll taxes, are entirely theirs to keep tax-free. And honestly, I don't blame anyone for thinking that way. It feels intuitive. You paid in, so why would you get taxed again on the way out? Here's the reality. For lower-income retirees, Social Security benefits are indeed not taxed at the federal level. But for everyone else, and that includes a huge swath of the middle class, many retirees completely overlook the surprising and sometimes severe tax implications that come with collecting Social Security. And by the time they realize what's happening, they've already lost thousands of dollars that they could have kept in their own pockets. So let me show you exactly how this trap is triggered. Because once you see the formula, you'll understand why it catches so many people off guard. The IRS uses a very specific and frankly somewhat buried calculation called combined income, sometimes referred to as provisional income, to determine how much of your Social Security benefits they're going to tax. Here's the formula. The IRS takes your adjusted gross income, that's your AGI, which includes things like wages, pension income, withdrawals from traditional IRAs and 401ks, capital gains, and other taxable income. Then they add any tax-exempt interest income you receive. And yes, that means interest from municipal bonds, which many retirees hold specifically because they thought it was tax-free. We'll come back to that. Then they add 1/2 of your annual Social Security benefits. Add those three numbers together, and you get your combined income. Now, let me show you how shockingly low the thresholds are. If you're a single filer and your combined income exceeds just $25,000, $25,000, up to 50% of your Social Security benefits suddenly become taxable. If you're married filing jointly, that threshold is $32,000, but it gets worse. If your combined income surpasses $34,000 as a single filer, or $44,000 for a married couple, the taxable portion jumps to a staggering 85% of your benefits. Now, I want to make sure we're crystal clear on what this means because I see a lot of confusion about this online. 85% taxation does not mean the IRS takes 85 cents of every Social Security dollar. It means 85% of your Social Security benefits are added to your taxable income and then taxed at whatever your marginal tax rate happens to be, whether that's 12%, 22%, or higher. So if you're receiving $30,000 a year in Social Security and you're in the 22% bracket, you could be paying nearly $5,600 in federal taxes just on your Social Security benefits alone. That's real money. And think about this. $44,000 of combined income for a married couple is not a life of extreme luxury. That's a very modest retirement. Yet if you hit that number, the IRS maxes out the taxable portion of your benefits. Here's where it gets truly frustrating. Because these threshold numbers are so incredibly low, and again, they have not been adjusted for inflation since 1993, millions of middle-class and upper-middle-class retirees who diligently saved in 401ks and traditional IRAs are walking right into a massive tax trap without even knowing it. Here's the mechanism. When you turn 73 or 75 starting in 2033 under the SCURE 2.0 Act, you're required to start taking required minimum distributions, or RMDs, from your pre-tax retirement accounts. You have no choice. The IRS mandates it, and that RMD money counts directly toward your adjusted gross income, which instantly spikes your combined income and triggers the Social Security tax. So let me paint the picture. You're 74 years old, you're collecting Social Security, you're living modestly. But the IRS forces you to withdraw, say, $40,000 from your traditional IRA as an RMD. That $40,000 gets added to your AGI, which pushes your combined income well above the threshold, and suddenly 85% of your Social Security benefits are taxable. You are, in effect, being punished for being a responsible saver. The very act of following conventional financial wisdom, max out your 401k, save in your traditional IRA, defer taxes until retirement, has set the trap. Let me pause right here and ask you a direct question. Have you ever calculated your projected combined income for retirement? Or did you assume your Social Security checks would be completely tax-free? Have you factored this 85% taxability trap into your future budget? Drop a comment below right now and tell me where you stand. Let's get a real conversation started in the comments section so we can all learn from one another's experiences. I read every single comment, and shining a light on these hidden IRS formulas is the absolute first step to protecting our wealth. So, how do you beat this system? How do you generate enough income to live a comfortable, secure retirement without crossing those combined income thresholds and triggering the Social Security tax? It's time for your Wealth Guardian Action Plan. Strategy number 1. Execute strategic Roth IRA conversions. The single best defense against the Social Security tax trap is the strategic use of a Roth IRA. Here's why. Withdrawals from a traditional IRA or 401k are taxable. They increase your adjusted gross income and push you right into the trap. But qualified withdrawals from a Roth IRA are completely tax-free in retirement, and this is the critical part, they do not count toward your combined income calculation. They're invisible to the formula. So, by converting your pre-tax retirement funds into a Roth IRA before you claim Social Security, you can drastically reduce your future taxable income and potentially keep your combined income below those critical thresholds. Now, you will have to pay income tax on the amount you convert in the year of conversion. There's no free lunch. But once that money is in the Roth, it grows tax-free. And when you pull it out in retirement, it won't trigger the Social Security tax trap. The smart approach is to convert manageable amounts each year, often during your early retirement years or in years when your income is naturally lower, so you don't accidentally jump into a higher tax bracket while making the shift. Think of it as filling up the lower tax brackets each year like pouring water into a glass, right up to the brim but not overflowing. Strategy number 2. Manage your withdrawal timing. Retirement tax plan isn't just about what you withdraw from, it's about when you withdraw it. Coordinating the timing of withdrawals across your different account types is critical to avoid crossing those combined income thresholds. Here's a practical example. Let's say you need to make a major purchase. Maybe you're buying an RV, paying for a significant home renovation, or covering a large medical expense. If you take a huge lump sum out of your traditional IRA in a single year, you'll instantly spike your combined income and cause your Social Security benefits to be heavily taxed that entire year. Instead, you need to think strategically. You might pull those funds from a tax-free Roth account, which won't affect your combined income at all, or you might tap into cash reserves. We always recommend maintaining at least 6 to 12 months of essential living expenses in liquid savings for exactly these kinds of situations. You could also spread the withdrawal across 2 calendar years to minimize the spike in any single year. The point is this: managing the timing of your taxable distributions keeps your combined income carefully controlled year by year, and that control is what keeps your Social Security benefits protected. Strategy number 3, invest tax efficiently. The way your non-retirement assets are invested also plays a significant role in this calculation, and it's an area a lot of retirees overlook. Now, here's an important nuance, and I want to make sure you catch this because it trips people up. Municipal bond interest is generally exempt from federal income tax, which is great. But here's the gotcha. That municipal bond interest is factored into the combined income formula under the tax-exempt interest line. So while it won't show up on your regular tax return as taxable income, it absolutely will count toward the calculation that determines how much of your Social Security gets taxed. It's one of those IRS quirks that catches a lot of people by surprise. That said, there are still tax-efficient strategies you can use. Qualified dividends and long-term capital gains in your taxable brokerage accounts generally receive more favorable tax rates than ordinary income. Growth-oriented investments that don't throw off a lot of annual income can help you control your AGI. And strategically placing different types of investments in the right types of accounts, a concept called asset location, can make a meaningful difference. By carefully structuring your portfolio across growth stocks, income-producing assets, and tax-advantaged accounts, you maintain control over how much taxable income is generated each year, preventing those accidental spikes that trigger the trap strategy. Number 4, and this is the one I told you to stick around for, optimize your Social Security claiming age. Determining when to claim Social Security is one of the most impactful financial decisions you will ever make. While you can claim as early as age 62, doing so permanently reduces your benefits by approximately 25 to 30% compared to your full retirement age amount. On the flip side, every year you delay claiming beyond your full retirement age increases your benefit by roughly 8% per year. Up until age 70, that's a guaranteed 8% annual increase. Hard to find that kind of return anywhere, but here's why this matters specifically for the tax trap. If you retire at, say, 65 but delay claiming Social Security until 70, you create a 5-year window where your income might be exceptionally low because you're not yet receiving Social Security. During those 5 years, you can aggressively execute Roth IRA conversions at lower tax brackets. You can strategically draw down your pre-tax accounts while your overall income is minimal. You're essentially draining the accounts that would have created future RMDs and shifting that wealth into tax-free Roth buckets. Then, by the time you turn 70 and start collecting your maximized Social Security benefit, which could be significantly larger thanks to those delayed credits, you've already shrunk your pre-tax accounts. Your future RMDs are smaller, your combined income stays lower. Your Social Security checks remain protected from the IRS, and you enjoy maximum long-term financial security. It's an incredibly powerful 1-2 punch. Delay, convert, and then collect. The government wants you to believe that taxes are an inevitable, uncontrollable part of retirement. But understanding these rules and planning proactively can significantly reduce your tax liability and protect your Social Security benefits from unnecessary erosion. You worked entirely too hard and too long to let the IRS silently skim the cream off your retirement income. Now and tell me, which of these 4 strategies are you going to look into this week? Are you going to explore a Roth IRA conversion? Are you going to rethink your withdrawal timing? Or are you considering delaying your benefits to age 70 to maximize your returns? Let me know below. If you found this video valuable and you're committed to protecting your financial legacy from hidden tax traps, hit that like button, subscribe to the channel, and ring the bell so you never miss our weekly wealth protection content. Remember, building wealth is hard, but keeping it is harder. Long-term financial security is a reality only for those who plan ahead, stay informed, and refuse to leave their doors wide open to the taxman. Stay prepared, stay protected, and I'll see you in the next video.